Did you know that some of the world's wealthiest investors use hedge funds to grow and protect their fortunes? But most people have no idea how they work or if they're even worth it. In this video, I'm going to reveal what hedge funds really are and what they're not, the real requirements to invest, what hedge funds we like best here at Third Act Retirement Planning, and the biggest risk and rewards you need to know before diving in. My name is Tommy Cloud. I'm a certified financial planner, and I run an investment firm. If you want to download our guide to investing in hedge funds, a comprehensive guide for individual investors, it's free. You can click on the link in the video and go to our resources page, give us your email, and we'll send you your free copy. So let's start with what is a hedge fund and how is it different? Hedge funds are private investment pools for wealthy individuals and institutions. And unlike mutual funds, hedge funds can use almost any strategy: buying stocks, short selling, using leverage, or betting on currencies and commodities, precious metals. They're less regulated, which means more flexibility, but also more risk and less transparency. And while we're talking about that, what is a hedge in regards to investing? Hedging is a strategy to limit investment risk. Investors hedge an investment by trading in enough that is likely to move in the opposite direction or not correlated to the movement of another investment. So a negative correlation would be moving in the opposite direction. A risk-reward trade-off is inherent in hedging. While it reduces potential risk, it may chip away at potential gains. And I really want to say that's the norm. The hedge fund index does not offer the same returns as the S&P 500. The S&P 500 has outperformed the hedge fund market in general over the last decades. However, the hedge funds that we look at offer little to no correlation to the S&P 500 while offering the same type, if not better, long-term returns than the S&P 500. And we'll talk about those specific ones here in a moment. So hedge funds aim for absolute returns, trying to make money whether markets go up or whether they go down. Who can invest and what does it take? You usually need to be an accredited investor, I would say always, which is a net worth over $1 million, not counting your home, or you need high income. We have hedge fund strategies for accredited investors and other investors, but we don't have any true hedge funds for accredited investors. Some funds, and that's the ones that we work with that are true hedge funds, require you to be a qualified purchaser with a $5 million plus in investments. And those are the type of hedge funds that we work with are for qualified purchasers. Now, I want to pause here and say, don't worry. You can create your own hedge funds, again, that we talk about on these videos time and time again, by using true asset class diversification into investments that are not correlated, but yet have high long-term rates of returns. Things like stocks, gold, real estate. And there's even a mutual fund out there that has a hedging strategy that works well, that has a long-term track record. You also have utility stocks. So you don't have to just do stocks and bonds. Bonds can't perform. They don't perform very well long-term. So you can use bonds as well. That will certainly lower the risk, but it will also lower the return. It is a non-correlated asset class, and you can use it to also create a hedge fund for yourself. That's what the endowments do. The Harvard and Yale endowments do. They use true low or no correlated asset classes to form an entire portfolio. The minimum investment in hedge funds, it can be as low as $100,000, but we don't deal with any that are those. Usually the ones that we deal with have minimums of 10 million and up. However, we, through our relationship with Crystal Capital Partners, we're able to get our clients in for as little as 500,000 and sometimes as little as 250,000. But those funds that we use, they require most investors that would go directly to them to have minimums of 10 million, 15 million, sometimes even 100 million. And these are the top hedge funds that I'm talking about. To me, the hedge fund market is at large a very mediocre place to get non-correlated performance. It's offering probably 6%, maybe even 7%. And we just don't deal in those type of long-term performance numbers. What we're dealing with are more market-like returns. Could be anywhere 10 to 14% is what we're seeing on our hedge funds. What you'll need to do though is you want to review the fund's documents, you want to understand the strategy and complete due diligence before investing. Are hedge funds worth risk, rewards, and what to watch for? Potential rewards. You have access to top investment talent, unique strategies. You get number 2, diversification. Hedge funds can reduce your risk in your overall portfolio, especially during market downturns. This is my favorite part about it, is the diversification that they offer. Some strategies have outperformed bonds and even stocks in certain. That's great too. You want good performance and non-correlated diversification to the S&P 500, and I think you're cooking with grease if you can get those two things. That's like the holy grail of investing, non-correlation to the U.S. stock market and double-digit returns like the U.S. stock market. If you've got that, like you do with gold and some of these other investments, then you're in great shape. And there are some hedge funds that do that. Most don't, but there are some that do have long-term track records, 10 plus years, that do have some of these type numbers. Risk and cost. They do have high fees. There's the old classic 2 and 20 model, which means they charge a 2% annual management fee plus 20% of profits. Some funds now charge a bit less, but fees are still much higher than mutual funds, as they should be. Illiquidity. Often your money's locked up for a year or more with limited chances to withdraw. Complexity. Strategies can be hard to understand and transparency is limited. And then performance. Not all hedge funds beat the market. Most don't. It's like mutual funds. Most mutual funds don't beat the market. In fact, after fees, many underperform simple index funds. So this is nothing to get jealous about unless you do have some of the elite long-term performers, and they truly are magnificent to see volatility of 4 or 5% compared to the S&P 500 of 17%. You're looking at volatility of a third of the index with equal returns. Say the S&P's done 11% a year over the past, let's say 5 years or 10 years, and then you have a hedge fund that's done 11% with 1/3 the volatility. That truly is something to be jealous about. How to protect. What you have to do is do your homework. You want to read the fund's offerings, check the manager's track record, so key. Can't be overstated to check that track record, and ask about fees, risk, and redemption terms. However, if you see the track record, you're going to see the net performance after the fees. Diversify. Don't put all your eggs in one basket. You're going to want to have other investments, not just all hedge funds. If you're wealthy, as you probably already know, you're going to want to have more than one hedge fund. So that's wise to make a portfolio of hedge funds. You want to work with a trusted advisor who understands hedge funds. That's important. Common misconceptions. Let's talk about those. Myth number 1, hedge funds are always riskier than stocks. That's absolutely positively not true. I would say most hedge funds are probably less risky than stocks actually, but most of them don't make as much money. Some hedge funds are designed to reduce risk, but others use lots of leverage. So know the strategy. Myth, only billionaires can invest. No, as we already talked about, the fact is while there are minimums that are high, many high net worth individuals can qualify. The best ones are available to the qualified purchasers. There are some, very few ones available to accredited investors that are good, but most are fair to middling and not even worth putting in your portfolio, in my opinion. Myth, hedge funds always outperform. They certainly don't. They usually don't outperform, and they underperform the S&P 500. Most of them do. Not all of them, but most. So some things about hedge funds can be a powerful tool for the right investor, but they're not a magic bullet. High fees, complex strategies, and limited liquidity mean you need to be smart, cautious, and well-informed. If you want to learn more about hedge funds, just set up a call with me and we can talk about them, how they might fit into your portfolio. And also, I recommend that you go onto our website, to our resources page, and you can download our e-booklet that we've created just about hedge funds, and you'll be able to learn more about hedge funds in detail there. Thank you for tuning in, and please remember to like and subscribe. We'll be coming right back at you with more videos for you to learn and become better stewards of the money that has been entrusted to your care by the one true living God. We'll see you in the next video.